Good morning, everybody. This is Kirk Spano, Fundamental Trends, Margin of Safety Investing, Blue Mound Asset Management. And today we are going to talk about investing in alternative energy using ETFs. If you have been paying attention to the news, you know that the infrastructure bill looks like it's going to pass in the next day or two. It has huge bipartisan support for a $1 trillion infrastructure package, which just so people are aware of this, the United States is somewhere between 15 and 30 trillion behind on deferred maintenance in American infrastructure, going all the way back to the 1980s. So while $1 trillion seems like a lot of money for infrastructure, it's probably somewhere in the order of 5% of what we need. So expect another infrastructure bill probably in a year or two or three. And I would expect that further infrastructure bills will have even more to do with alternative energy. Here's what this bill looks like. And I don't think the number is all that important right now because it's going to go up. The amount of money from the infrastructure bill towards alternative energy is going to rise substantially in future budgets as climate change becomes more impactful. As I have discussed with you before, the Pentagon and the CIA are saying that the greatest threat to America is climate change. And that has to do with the migration and the impact, various impacts of climate change, not only on the US coasts, but also interior, the stronger storms. We had over 50-mile-an-hour winds again here in Wisconsin. And I say that knowing full well that people say, well, a storm is a storm, they just happen. The weather has become more severe. There's empirical evidence to show this. Some of our satellite investments are providing this information going back decades now. And we can see that the collected data from old satellites and now these new companies with their data, the trends are pretty much irrefutable. You know, the debate on climate change is basically over, except for people who just want to argue about things. We know that this is a major, huge secular trend. And when governments start to spend a lot of money on it, which they've spent quite a bit already, you know that it's just going to keep coming. So if you want to argue that this is just a way to propel the economy and that it doesn't really matter to the climate, whatever, I don't really care. What I know is that a lot of money is getting pumped into this area. And we're talking trillions of dollars. Trillions of dollars. So this is a drop in the bucket. But look at some of the things that they're talking about. Carbon capture. What was one of our newest investments? Had to do with carbon capture. Clean hydrogen. What is one of the companies that we are invested in that is a backdoor play on clean hydrogen? So as these things happen over the next decade or so, you're going to find more and more money heading in this direction. It is the biggest secular shift, I believe, in history, going from the fossil fuel age to the post-fossil fuel age. And it doesn't mean that we won't be using any fossil fuels. It's just that there's going to be a dramatic reduction. Coal is going to virtually disappear. Oil is going to become a niche product. And natural gas is probably only going to be used for cooking in the future. But that's probably, 30 years away. Until then, it is the shift of the energy mix that we should be looking at, and all the things that come with that: transmission lines, energy storage, how we apply it to transportation, how it impacts the petrochemical industry. There's a whole long list. So if you're looking for disruption, you could pretty much just make a career on the disruption in the energy sector. And the infrastructure bill isn't the only thing to look at. The reconciliation bill that's coming, which I think is going to end up being way larger than people expect, is coming too. So they've been talking about $3.5 trillion. Well, they were talking 600 billion here originally for the infrastructure bill, and it ended up at $1 trillion with bipartisan support. And that was a way to make everybody feel good about bipartisanship again, try to reduce the amount of conflict. However, the reconciliation bill, you can already see the saber rattling, and the Democrats, especially the far left, are going to push for more and more. And that means that Joe Manchin over in West Virginia is going to ask for more and more. Already $200 billion is likely to go to West Virginia. And this is going to have to do with transitioning away from alternative energy because he has all those coal miners. So he's going to put together a very nice plan so that people in West Virginia can transition from coal jobs into other types of jobs. And I have tweeted with him. He hasn't responded, but I'm fairly certain, because I did get something from a staffer by email, there's probably going to be some sort of sub pay for people who lose their job in the coal industry. And I actually think it's going to go across all fossil fuel industries. If you're in fossil fuels and you lose your job, you're going to get some sort of sub pay. What is sub pay? Well, we just had sub pay. The PUA and PUEC, I believe, or maybe PEUC, but the pandemic unemployment benefits with the extra 600 a week and 300 a week, those sorts of benefits are going to be given to people who lose jobs at the fossil fuel industry level. So if you're a coal miner or something to do with the oil rigs or whatever, and you get displaced, you're going to get extra benefits. And we've done this historically at other times. We did it during the financial crisis. There were extra benefits for people who were displaced. So expect the compromises on this bill to drive the size of the bill up. So one of the things they're talking about is extending the residential tax credit for solar to 30% for the next 5 years, and then gradually phasing it down to 10% permanent credit after 2028. That's just one of the ideas that are out there. Joe Biden just wants to extend it for 10 years. I think that you're probably going to get both. I think you're going to get a 30% tax credit for solar, and I think it's probably going to last for 10 years. Maybe they phase it out near the end. Something in that realm between these two ideas is what's coming. It's going to be very, very big for solar, but what else does it mean? It means that the transmission system, means that the grid has to be significantly upgraded. And what's going on in the infrastructure bill, $73 billion for that, isn't going to be enough. So more is coming. And those companies that benefit from this are going to have a very bright future. So the Senate Energy Panel's reconciliation ideas were summarized in Politico, I believe it was yesterday. But here you see, I mentioned Joe Manchin. He's going to be responsible for at least $200 billion of the bill, and I think it's going to be $500 billion, give or take. One of the important things is that it gives FERC a lot of new authority. FERC is the Federal Energy Regulatory Commission, and we have been familiar with them because of the natural gas export facilities that we've invested in the past. What this bill essentially does is it gives FERC the ability to override state commissions. So in some of the states, particularly with entrenched fossil fuel interests, where they want to upgrade the grid or add transmission projects to facilitate renewable energy, and the states stand in the way, FERC is going to override them. So these projects aren't going to be stopped at the state level. Federal government is federalizing this. And once again, that speaks to how important this is. Some of the funds that are out there that we can invest in. We have PBW, the Invesco Wilder Hill Clean Energy Portfolio, Q Clean from First Trust, ACES from ALPS, iClean, and TAN. Now, PBW, iClean, and TAN have been on our radar for years. And in the past, I always just erred towards using TAN. However, PBW is more diversified and more level. So when we take a look at these two funds, we can see that the solar fund versus the more diversified fund differ in a couple of ways. First off, TAN has fewer holdings, solar, and it's top heavy. Whereas PBW is a more level allocation across more stocks. What I plan to do is to use one of these more indexy investments as my core holding, and then I will probably swing trade the solar ETF. Now, one of the things that I'm talking about with Shooter is we're putting together a swing trading article to specifically help people. And one of the ideas that we talk about is how much should you be swing trading? Now, Shooter is a professional swing trader, and he only swing trades about 5% of his net worth. I think that you can go up to 10% pretty handily, but you really don't want to go much past that. You really have to be a daredevil to go up to, say, 20%. So my weighting here is probably going to be mostly PBW and then a little bit of TAN. So my core position will be PBW, and I will trade this, but I'll trade this. I'll buy the dips, I'll sell the rips. I'll buy the dips, I'll sell the rips. In comparing various funds, I can take a look at what TAN looks like in comparison to SPY and QQQ. Notice this is QQQ over the last couple of years. And we can go all the way back to 2018, which I think is about the right time to go back to because we had those two big corrections in 2018. So QQQ, SPY with the zombies, TAN and PBW. They track pretty closely, even though their construction is quite different. That tells me that the trend in that area is pretty darn strong. Now, when we chart this out to get expectations in a moment, I will show you that I actually think that PBW can make a run at 300. In comparing the other ETFs that I'm going to have on the list, I'm going to add QClean, even though I don't like the First Trust guy. And I'll probably add ACES, the Alps fund. But I'm going to do a little bit more breakdown on the holdings just to make sure that we don't have identical sorts of things. What I could do is just put in the notes, hey, QClean is pretty similar to PBW, something along those lines. And again, you take a look here, comparisons. TAN is the leader here since 2018. We'll go like that. There we go. TAN, PBW is blue. QClean is the dark orange. So QClean and PBW perform about the same. So I'm going to do an analysis of the holdings just to make sure that we're not missing something. iClean is down here, much more globally diversified, and it has less of the meme stocks that have done so well. So this might be an idea to use if you're afraid of some of the meme stocks like Tesla collapsing. And then ACES, which again, I haven't completely done the analysis, but the screening says probably something to keep on the radar. So what I want to do is chart out PBW for you. When we chart this out, what we're going to find is there's an awful lot of upside. The trend retracement, you pull it from bottom to top. So there's your top, there's your bottom. This gives you your basic fib levels. The 786 line is probably the absolute bottom, but the 618 in the middle 60s is probably a good place to be. So I pretty much eyeballed that one correct. I am anticipating here that the correction goes down to the mid 60s, and that is what gives us the extension. Now, if the correction doesn't go that low, then I'll just have to adjust where the bottom line here is. But right now, I'm just projecting out. That's what we get. When you pull this back, what you see is a 1.618, which is a normal extension down here and then up, be all the way up around $250. And what do we know about the stock market? It likes round, shiny numbers. So I think you could see PBW make a run at 300. And here's a couple reasons why. One, just the technically driven nature of the market and the fact that this is a rapidly expanding industry. The profit levels are going to skyrocket at some point. particularly for some of the software companies and the companies to provide monitoring services, recurring revenues without having to put a lot of inputs in. So again, asset light approaches. One of our companies, Sun Power, has moved to a very asset light approach, right? They're not so much a widget company anymore. So when we take a look at where some of these stocks can go, you start to say, well, I mean, they could 10x their earnings because their earnings are so low right now. A lot of that is priced into the stocks, and especially was here. And now we're getting an A, B, C correction probably, Elliott wave stuff. But just you can eyeball this and know that it looks like about what it's going to do. So we can get this in the 60s with the idea that it's going to head up into the 200s and maybe make a run at 300 4 or 5 years out. Pretty interesting. But wait, there's a little bit more. What if, and I know this is going to be hard to believe, what if the Fed tapers and then untapers? What if there's more QE in the future? What if they never actually flatten the QE line? Maybe they just make it a little less extreme. And once the correction from the shock of taper and people running their mouths and saying, oh my God, they're tapering, they're taking the money away, we're going to crash, depression. What if that's just a brief moment in time? What if QE is forever? What if modern monetary theory is really what we're doing and we're just not admitting it? In which case, the perpetual inflation that we see in asset prices, because the money has to go somewhere, drives prices up even higher at some point this decade. In that situation, you want to be where the most money is going. And if fiscal policy is driving funny money towards these industries, that's where we want to be. So I think there's a very good possibility that at some point, I put probably about a quarter of my money into these two funds, PBW and TAN. They pay a little dividend, but more importantly, they're volatile enough that if you want to be an option seller, you can make an awful lot of money in premiums by selling puts on the dips. Hold your core position, sell puts every time there's a good correction. And just create once or twice or 3 times a year your own dividend-like income. So that'll be a focus of the retirement income options articles going forward, I think, is where can we sell high premium puts on stocks and ETFs that we'd love to have at those prices? What types of questions do we have about this alternative energy space and investing in it? What percentage of my alternative energy should be in ETFs versus stocks? I think I'll probably split that up 3/4 and 1/4. Probably have 3/4 of my money in the ETFs, mainly because I'm going to split that up into an index fund like PBW and an industry fund like TAN, the solar. And then I'll have my basket of probably about a half a dozen stocks only. Could go up to a dozen, but in the half a dozen to a dozen range of stocks that I want to overweight. So maybe an extra % or 2 in Sun Power, a % or 2 in Enphase, or, if Enphase ever comes back to where I think it's, a growth stock at a value price. So that sort of structure, and you could probably go 50-50 if you are more aggressive. Imagine what the world was like before we had oil and coal and natural gas, and how big those industries became. The oil companies, the coal companies, they became some of the biggest companies in the world and still are. They've shrunk. At their peak, I believe it was 7 of the top 10 companies in the world at one point were oil companies. Exxon, right? A bunch of the standard oil companies that spun out, and then several of the international companies. The time frame on that is the hardest part to understand. When do things happen? What weird things happen in the meantime before oil is a niche product? But one thing to keep in mind is that all the projections about how long it was going to take for oil to lose demand have all been wrong, because none of them have been aggressive enough except one. Tony Seba has been pretty much on the money here. So we are already just about on the peak oil plateau. that period where there is no increase in oil demand, and we know that oil demand growth is under 1% now, heading towards zero very quickly next couple of years, and that shift towards electrification is coming. So as we see supply and demand imbalance in oil at some point, right now there's more demand because they're holding supply back, and eventually demand will flatten. Supply will go up because producers will get desperate. Price of oil will go down. A bunch of bankruptcies will occur, and then the price of oil will go back up. But through this whole thing, it's caused by the electrification and the move towards clean energy. Efficiency is driving a lot of it too. So that's the message. You need to plan to be heavily invested in the clean energy revolution. Government policy is driving it. Demographics is driving it. Technology is driving it. There is no stopping it. It's going to be the biggest trend the rest of this decade and probably the rest of the next decade. Have a great weekend. My COVID test came back negative after a week in Las Vegas. So I'm going to go to the Wisconsin State Fair on Wednesday, and then I'm going to do a little fishing on Thursday. You will see a retirement income options article tomorrow, along with a stocks of the week article. And then the Global Trends ETF got a little bit of an upgrade, as I'll be using both my charts and Scott Henderson's shooters charts, and coming up with a couple of more specific trading ideas for you. So have a great weekend. Enjoy the weather. If you got good weather, and if you don't have good weather, we went and saw Black Widow last night. It was pretty darn good. So if you need to go sit in a theater because you have one that's empty, like the one by me, we literally went to a Friday night movie that had 11 people in the theater. I am masking up anytime I'm in public now because the Delta variant is serious, and the new one, Lambda, could be more serious. So I'm going to probably mask up through the spring because I don't want to catch it again. And I really don't want anybody's flu either. Have a great weekend, everybody.